Hi, I'm Darrell Mark with South Dakota State University. I'm a professor of agricultural economics and one of the iGrow market analysts. And today what I want to do is spend a little bit of time talking about basis. Now basis is maybe not one of those real fun and exciting type of topics to some folks, but it's actually quite important, and it's very important when you're thinking about marketing and in particular risk management using derivative products like the futures and options market. And there's some things that have changed, I think, about basis over the last few years, and I want to spend a little bit of time highlighting some of those things for you today. Now, many of you have seen lots of references to what basis is. Basis is the cash price minus the futures price. Okay, so oftentimes that's the only explanation you're given. So apparently that's important for some reason. That's why I want to talk a little bit about that. It is very important when you're hedging with futures and options. And those that's not the issue that I'm going to really get into today. If you're comfortable using those kind of derivatives for hedging your production on your farm or your intended purchases, great. You need to understand how basis is related to that, and the fact that you're really only protecting a cash price with the futures price. You're still at risk on the basis changes. Now, it used to be maybe 10, 15 years ago, we didn't really care very much about that because basis didn't change all that much. Basis is much more variable today than it ever was, and that's what I'm going to show you a little bit here. But the reason it's important, or what essentially basis is measuring, is local supply and local demand conditions relative to the overall world market or U.S. market, as the case is. The basis really reflects something that's happening in a very specific type of market. Okay, so let's just look at a couple of definitions here so that we can talk about as we get started here. Important to remember that sometimes basis is negative, sometimes basis is positive, and it depends on the commodity and it depends on market conditions. When you have a positive basis, that's going to happen when the cash market price is greater than the futures market price. So for example, if you have a cash price of $5 and a futures price of $4, you have a positive basis, $1 positive basis. Again, remember, basis is cash price minus futures price. So if your futures price turns out to be higher than your cash price, you're going to have a negative basis. Now here in South Dakota, most of the time in the grain market, in corn and soybeans and wheat, we're going to have to talk about a negative basis. And oftentimes people forget to say, or it's just implied that we're dealing with a negative basis. In the feeder cattle market is a market that we typically will have a positive basis. Normally our prices for those good South Dakota calves are going to be a little bit higher than the market average as represented by the futures market, so you're going to see a positive basis. A couple other things, though, that I want to point out from a definitional standpoint as we get started is how to interpret changes in basis. And usually we say things like strengthen and weaken. Getting higher or lower is a little bit confusing when you're dealing with sometimes negative, sometimes positive numbers. Think about the real number line, and I've just denoted that here going from negative 20 on up to positive 20. When you get less negative or more positive, your basis is strengthening. When your basis is weakening, that's when it's becoming less positive or more negative. Okay, so keep that in mind here as we go. These changes in basis, the strengthening and weakening of basis, tends to happen for a variety of reasons in the local cash market. One of them tends to be by the quality of the commodity that's being marketed. Like I said a minute ago, those good South Dakota calves, well, they tend to be of a higher than average quality when looking across the United States, just because of the genetics and breeding that are typical in this area of the country. And as a result, you're going to see prices a little bit higher in the cash markets, and that tends to add to a stronger basis, for example. But geographic location also tends to influence a lot where how cash prices vary in certain places, and I'll show you that as well. The main reason for that is transportation costs tend to change. Now, that's probably most evident in looking at the grain industry, for example, and in particular where our export markets are at. Oftentimes our prices in the past were driven heavily by how far away you were from the export terminals. Now with the advent of ethanol, for example, in the upper Midwest, we don't tend to see quite that much of a drive there because the local supply and the local demand conditions have changed a little bit. Just come back to that quality issue first here before we look at the transportation example. Here I'm showing you the basis for 500 to 600 pound steer calves in the South Dakota combined weighted average market. So an average of about 7 sale barns across the state of South Dakota, and I'm showing you on the black line on this screen the average from 2009 through 2011. The blue line is actually where basis was the first month and a half or so of 2012. So again, this is the cash price minus the futures price. I'm looking at the cash price of 5-weight steers relative to the feeder cattle futures contract at the Chicago Mercantile Exchange, and that price is based on actually a heavier weight steer price, a 7 to 850 pound steer price. So we take a look at that basis calculation, again, cash price minus futures. When you do that, on average on that black line, you can see for about the first half of the year, it tends to be around $20 per hundredweight. Later on in the summer and in the fall, you tend to see a little bit lower, maybe closer to about $10 per hundredweight at times. The reason it's stronger at some times of the year than other times is the relative supply. It tends that from August through about November, we have a lot more feeder cattle, or those lightweight steer calves, 500 to 600 pounders, being marketed in South Dakota than we do in March and April. As a result, the basis tends to be a little bit weaker than the seasonal average or the yearly average. Now notice there in 2012 is almost an anomaly in some respects, but there's market conditions driving that basis to be almost $30 or at least $10 per hundredweight stronger than it normally is. That's because calf supplies are very tight right now, and there's very strong demand from cattle feeders out there for purchasing those lighter weight calves, and that's driven our basis much higher. Now on this slide, I showed you 500 to 600 pounders, and I want you to compare this slide to the exact same information, but for 700 to 800 pound steers that you see on this graph. Now, even though I changed the axis a little bit on the vertical axis, and maybe I shouldn't have done that, but what's important to note here is that the numbers have changed on average. You're still looking at exactly the same futures market, the CME feeder cattle futures contract, but now we're looking at cash prices for 7 to 8 weight steers, which is essentially a weight difference is a quality differential, and you notice here that the basis numbers are much smaller, and it's because the dollar per hundredweight price of a 7-weight steer is less than the dollar per hundredweight price of a 5-weight steer. Okay, now compare this slide to a different quality differential, the same weight of cattle, but instead of steers, we'll look at heifers on the next one. So that drops maybe from an average basis of around $4 per hundredweight for the steers. Now looking at the heifers, you're looking at an average basis of maybe more like about negative $4 across the year for those 7-weight heifer calves. So the point here is when quality changes, the basis changes. So that's one of the things that tends to drive changes, at least from a historical standpoint. One of the other things, like I mentioned, is transportation. South Dakota, eastern South Dakota grain markets traditionally have had one of the most negative basis or most weakest basis in the country because we're the farthest away from the export market in the grain belt. And you can even see that comparing maybe our 5-year average, but you really have to go back farther. But just looking here at the Southeast corn basis information, the 5-year average on the red line, in 2012, you notice that we're trading at a much stronger than average basis. The reason for that was good ethanol processing margins ending 2011, good demand for local corn there, and somewhat tighter supply because the 2011 growing season was very difficult. We lost a lot of production in the state as a result of flooding along the Missouri. So those things combined to have a little bit stronger than average basis. But compare, for example, Southeast South Dakota basis running at about 35 under on corn there in early 2012 to north central South Dakota, even a little bit farther away from some of those export markets. And instead of running about 35 under, now you'd see we're looking closer at about 40 under for the beginning part of 2012. On average, the more interior your markets are, the weaker your basis is going to be if you're farther away from export markets. However, if you start building a lot of ethanol plants or cattle feed yards or poultry production operations or pork production, you're going to start seeing more local demand for the commodity, and your basis will strengthen as a result. So that's one of the reasons we've had a stronger basis in the last few years in eastern South Dakota than we have in the past, just because our demand or our uses have changed. Okay, the other thing I wanted to talk a little bit about, we don't normally talk about this at all on the livestock side, it's really not relevant, but on the grain side it's very relevant, is what your deferred basis is. Oftentimes we think about what is our basis relative to some of the deferred months, and that's important because most of us, especially in this part of the country, tend to store our crop for a long period of time before we market it. So if you're looking at a storage hedge, for example, maybe if I'm combining my corn in October or November and putting it in my grain bin, with intentions of selling it in July of the following year, I might be placing short hedges in place. The way to capture the appreciation in price level going out into the summer months, if you're selling your futures commodity, is through the basis appreciating during that time period. And typically it tends to. In other words, basis is that mechanism that entices us to sell in deferred months. In other words, typically if the market pays us to deliver a commodity in a month other than when it's produced, there's a carry in the market which you can capture through the short storage hedge, but basis has to also improve during that time period to pay for your physical cost of storing grain. Now, actually getting into the whole conversation about a storage hedge and how deferred grain basis is important is probably a topic of another podcast, but I did want to show you graphically here that sometimes we look at that information and how that appreciates over time period. And what you're looking at here is for an eastern South Dakota market on I-29 and for corn, and this is actually for July delivery of corn. And so what you note here is on the bottom the 3-year average basis calculated against the deferred July contract going out, for example, from about 1 year prior to delivery. Again, we're in 2012 here, so we're looking all the way back from July 2011, what were the basis bids at that particular corn market going out for delivery in July of 2012. And you notice on average, on that black line at the bottom here, that price, that basis tends to appreciate over time. The blue line is what actually happened for 2012 deferred basis, and you can see it started lower than normal at about 60 or 70 under, but it ended up increasing to about 23 under the futures market. So that basis does tend to change over time period as well too. One of the comments that I made here and what I want to talk about is the fact that basis is becoming more variable. And in fact, on this particular graph, I'm just showing you the basis for number 2 yellow corn in Omaha, Nebraska, going back to 1997. And you can see that some of the amplitude of these changes have gotten to be a little bit more in recent years. A different way that I'll show you, and maybe a little bit more clear than looking at that particular graph, is by looking at this one. Now on this graph, I'm showing you the standard deviation of yearly corn basis, again in the Omaha market. It's going to be similar in most any location I pick in South Dakota as well. Standard deviation is a measure of variability. It's a measure of riskiness, essentially. And so what I did was within each year, I calculated the standard deviation of basis going back to 1997. And you can see in the last few years that basis has really become a little bit more variable over time. In other words, there tends to be more risk associated with basis. So our futures hedges that don't cover us on basis tend to be not quite as effective at covering 100% of our cash market price as they did in the past. Of course, it varies a lot by year to year, but the fact is basis is getting more variable. So why is basis getting more variable? Well, like I've already alluded to, some of the conditions that are happening in the local market are changing that, local demand being one of them. The presence of ethanol plants, additional livestock numbers have both ended up adding another use market or another sink for grain buyers to be purchasing grain, tends to bid up local prices more relative to other places in the region or in the country, and that's a supported basis. But when you have ethanol plants, for example, that are being influenced by their own profitability margins that are related to ethanol subsidies and other market factors that drive their profit margins, they tend to use more or less corn depending on whether or not they're profitable. And so that's a number that tends to change there as well. We've seen a lot of change in livestock numbers in the last few years too. Even the poultry industry that had been growing at a pace of about 5% per year over the last 20-some years has actually seen declines in the number of birds in that industry as well. So we're seeing more variation in livestock numbers as well. One of the other big changes that we've seen over the last probably 15 to 20 years is the increased shipments to the Pacific Northwest markets. And that's actually placed states like North and South Dakota and other upper and western Corn Belt states at an advantage relative to some of the traditional Corn Belt states that were located close to the Mississippi River and could ship down to the New Orleans market. In the past, most of our exports from the country have exited the country through the NOLA market. down there in New Orleans. But now we're shipping almost as much grain through the Pacific Northwest as what we do through New Orleans because of the lock and dam system getting antiquated on the Mississippi River. As a result, we built more rail lines that are and more shuttle car loadout facilities, and more of that grain is heading west and going to Asian markets. That's been a change in our local demand as well, and one of the things that has tended to make basis maybe a little bit stronger, but probably more variable as well. Some of the other things that are influencing the variability of basis have a lot to do with changes in the futures market. Futures market prices themselves are much more variable than they ever have been in the past. The daily price changes are larger than they've ever been in the past, and the daily maximum trading limits, higher or lower, are larger than they've ever used to be too. One of the big changes that's influencing us on the futures market is the presence of a lot of non-commercial fund buying type of traders. Often we call them index funds. What we end up seeing in the futures market as a result of these long-only index funds tending to buy futures contracts in the nearby or the spot months, what they tend to do when that month, when that futures contract is nearing expiration at the beginning of the month, they'll sell huge volumes of that contract and then establish their long position in the next deferred futures contract out. We call that the Goldman rule. The reason I say that's important when thinking about basis is all of a sudden you see wide fluctuations in your basis, because all of a sudden, not that your cash market price is changing, but within a 2 to 3 day time period, as these index funds are rolling their positions to the next month, you see some dramatic short positions being taken or used to offset previous long positions in the nearby month, and the long positions being reestablished in the deferred month. So you see quite a little bit of spreading action within a period of about 2 to 3 days. The other reason I mention these non-commercial traders is because they tend to trade more on technical signals. They tend to trade more on the establishment of long positions, because they typically tend to trade long in the stock and equity market. And as a result, they're probably not as closely tied to the cash fundamentals as what commercial hedgers tend to be. And as a result, the market can fluctuate around what the true supply and demand for a particular commodity might imply for prices, and it creates more volatility around what that number is. Another thing that has caused basis to get more variable on the futures market side is the convergence issue. And some of you may be familiar with that or have dealt a little bit with that in some markets. Basically, there's difficulty, there has been in the last few years, not as many in the last year or so now though, but the convergence of the cash market and the futures market when that contract goes into delivery. That's become an issue in some markets, particularly farther east and farther south of us. And I'd invite you, if you're interested in that particular issue, go to the University of Illinois at Urbana-Champaign, go to their website, farmdoc.uiuc.edu. There's more information on convergence there and how that's influencing some fairly dramatic basis changes in a very short period of time. One of the things that I think is most important to point out in basis variability, and some of the things that have changed though, are what's happening in the cash market with respect to how we use the futures market. Even for those of us that may not use the futures market ourselves to hedge commodities, most of the people that we're, for example, selling our corn and beans to in terms of co-op elevators or other grain buyers are probably offsetting their risk in the futures market. So futures market volatility has increased their margin requirements and their potential for margin calls. As a result, for them to maintain their position in the futures market, it costs them more money to do that. They're going to pass those costs along to you in terms of probably a little bit weaker type of basis bid, but probably one that changes a little bit more than it ever had been too, because they need that extra capital there. They're building in a risk premium essentially into their basis bids. Another thing that we're noting here in very volatile markets, and particularly ones where they're rising very quickly, oftentimes being driven by these index funds, is cash market participants, grain buyers for example, may not necessarily believe the fundamentals associated with these price level changes, or view them as being very short-lived, and because of that, they often don't rally their basis as much, or in other words, keep their cash price at a one-to-one relationship with the futures market increases. For one thing, they may not have to in a rising market. They may not have to increase their price that as much as the futures market increase just to get price levels to go higher and get some grain bought. The other reason is because they're going to have to margin a short position in the market. They're taking a short futures market position. As the market price continues to move higher, they're going to end up meeting more and more margin calls, and again, that increases their capital requirements for maintaining their risk management position, and they're going to be conservative on a basis bid there too. One of the other things that I think is kind of interesting and especially getting to be more and more true amongst farmers and ranchers is that I think folks are more cohesive probably in the last few years than they have been in the past in terms of their attitudes towards price direction and when they make marketing decisions. It's very common now when I talk to grain buyers, for example, that they say nobody is selling. And when they say nobody is selling, they mean I haven't been contacted by a single farmer today that's interested in selling. And that might be true in the livestock side, and it might be true on the opposite side, on the buy side as well as the sell side for farmers. But it tends to be that there's a little bit more of a herd mentality in some respect, and I think it's not driven by a follow the leader thing so much as it is communication technology is so much more advanced that it tends to unite producers, whether it be through websites, through blogs, through text messaging, a variety of different things. It tends to be that there's more agreement on where future prices may be headed, and as a result, producers tend to make decisions to sell and buy at a more similar time period. We see more lumping of those kind of sales and purchases. The effect of doing that essentially the lack of farmer selling, for example, tends to strengthen basis, but all of a sudden when you do see a large farmer movement of grain, for example, you're going to start seeing some basis weakening rather quickly. That's one of the reasons in early 2012, for example, that we saw a fairly strong grain basis is just because farmers weren't really selling much of anything at that time period. So that's another reason why basis is getting more variable. So in addition to thinking about all these changes with livestock numbers and ethanol plants, all these other things related to the volatility in the futures market and some of the changes in cash markets and how producers are making their sale and buy decisions are tending to influence us more and more in terms of the volatility of basis. Again, very important when you're hedging, and so you want to be thinking about that. And we'll talk more about hedging in a future podcast on iGrow. But for now, if you're interested in more information on grain basis in South Dakota, there is information there that Dr. Dearson supplies at igrow.org. Look under agronomy and profit tips for that information. So with that discussion of grain basis, again, I'm Darrell Mark for South Dakota State University Extension and iGrow Market Analyst.